Good afternoon, students in my macro class. I'm back again for another lecture over another topic. And today we're on to topic number 21. Let's go to do I have it open already? No, I don't see it. I think I'll close some of these from the last topic 20 that I had. And, oh, here it is. I'd already open this up. Let's go to courses and get into our course. And it looks like I still have lecture topics open. Let's click on that. So I've already opened this exam too. It's right here. And so we're on aggregate demand. And I guess now is as good a time as any to say that, well, we've been in macroeconomics for a while. Actually, for even before question 14, let's take a look at exam 1. So if we scroll down, we can see basically from topic 12 on, we've been in macroeconomics, but we've been mainly talking about the data used in macroeconomics to talk about the business cycle, price level fluctuations, and how they're measured. Here in this course, we usually talk about the CPI, though probably in the macro course at the intermediate level, they'll say more about the GDP deflator. And then about employment and unemployment here in 14 and 15. And then we get to the circular flow diagram because we want to talk about GDP, and that helps us talk about it. So GDP, which is a big deal here in macroeconomics, is discussed in, let's just say, 16, 17, 18, 19, and 20. And so now we get really to the theory of macroeconomics. And fortunately, it looks a lot like microeconomics in that we'll be talking about supply and demand. But not just supply, aggregate supply and aggregate demand. And we'll also be talking about shifts versus movements along the demand curve and shifts versus movements along the aggregate supply curve. This one right here is really important for macro Keynesian economics because it's thought to be a aggregate demand management theory, what the government can do to influence aggregate demand. And just this past week, we've seen one of the most significant changes in government policy to try to stimulate the economy from the devastation that it faces from the coronavirus order to stay at home. If you're staying at home, you're not producing goods and services so much anymore, even though fortunately I can, but many people cannot. So we'll have to see what happens with this. Anyway, that's going to play a big role. And as far as shifts in supply go, we're going to see not only are we seeing a huge decrease in demand as everyone is staying home and not buying as much as before, but we're going to see the fact that they're not producing is going to shift the aggregate supply curve too, both of them to the left. And if we're measuring GDP on the horizontal axis, we know that means a big fall in real GDP, a big recession. So hopefully, I'm being over dramatic here, and it's not going to be that bad, but it certainly doesn't look that great right now. So we're going to use these to sort of explain maybe what's happening now and what's been happening in the past, these aggregate supply and aggregate demand curves. And in general, in 25, we're going to put them together and to explain and illustrate both long-run and short-run equilibrium, and explain and illustrate two basic causes of recessions. So we'll put them together at that point. Then we're going to apply the theory to two different viewpoints. One is the classical viewpoint, basically classical liberalism, uh, which basically says, don't interfere in the functioning of the market. Things will be better in the long run, if that's the case. And we'll briefly look at that point of view in 26 and 27 using aggregate supply and aggregate demand. And then from there, we'll take a look at our main actor in this course. This course often is called a course in Keynesian economics. And so we'll take a look at Keynes's theory of the classical economist and how his criticisms led to his theory and his proposal to manage aggregate demand, as President and Congress are attempting to do, even the last week or so. And then we'll follow up with his theory in topic 30, 31, 32, 33. And let's just bring up exam 3. Open in a new one. Here we go. And so wherever we got up to 33, 34, 35, 36, 37. So basically, for almost 9 topics, we're going to be into Keynesian economics. And we're really not out of it in the next ones about money, but some neoliberals, I guess if we use Latin American terms, did arise to challenge Keynesian economics, and they did so through their discussion of how money impacts the economy. And by the way, all the news has been about fiscal policy, the $2 trillion stimulus. But the Federal Reserve has been pumping a lot of money into the system right now to what they hope will cushion the fall in the GDP due to the coronavirus. And we're talking about monetary theory then, which is also a demand management, aggregate demand management. They're trying to manage demand through credit, 38, 39, 40, 41, 42, 43, 44, 45. And I'm not sure we're going to get it. By that time, it's going to be the end of the semester. Too bad we can't go, but it's 46, 47. And then we start talking about the Keynesian demand for money and transmission mechanism, etc. And maybe we can get to all of those. Who knows? I'm not constrained really by class time, am I? So there you go. That's the future. This is theory and applied to history and to events happening right now. So let's take a look at that. Let's come into PowerPoints if we might. And really, I can turn that off so it looks cleaner. And let's take a look at PowerPoint number 21. Here we go. And let's open in a new tab with Microsoft PowerPoint. Let's enable editing. And let me draw. That'll be good. So let's start with aggregate demand. Its definition. It's the quantity demanded of all goods and services. That is real goods, not nominal ones, at different price levels, ceteris paribus. Aggregate demand curve is just a curve that shows quantity demanded of all goods and services. So I can start drawing right now, if I can just find my pen. Here it is. So as far as this goes, let's take a look. I guess I have, let me do the highlighter. We can talk about aggregate demand curve. And where can I draw this? I guess I'll draw it right here. Let me use this black pen. And let's see. Let's draw. I wish I could draw straighter. All right. And so going upward, we have the price level. And on the horizontal axis, going this way, we have real GDP, which your textbook talks about as Q. And I guess we can say this is P. Now it's interesting that earlier, when we defined GDP, I think in number 17, we said nominal GDP equaled the price level times real GDP. Okay, so really if you multiply these together, you get nominal GDP. Let's just use this for nominal, whoops, oh well, left the I out there. So nominal GDP equals P times Q. And basically the aggregate demand curve slopes downward into the right like this, much like a real demand curve. Though it is interesting to note also that, okay, let's just say below here is macro. I'm talking macro here. Over here we talk micro, right? And in micro, it's not real GDP. It's just one good. So real GDP is an agglomeration or an aggregate, I should say, of all goods and services, haircuts and tractors, if you will. But over here, we can talk only about haircuts in the market or tractors or apples. That's micro, one little product at a time. And here we have, I'm just going to do this as price per unit and the quantity of a good, a particular good. All right, this is of a particular good, say gallons of gasoline. And the demand curve looks like this. It's not aggregate demand, it's just demand. And we might just want to, as long as we're going to be talking about this, down here we're going to be talking about why does it slope downward. You can see we're going to get to that. Let's talk about that right here. Let's make this a little thinner. So basically, if the price is here, then the quantity demanded at that price is going to be here. And if the price goes down, the quantity demanded at that price is here. So if the price falls, the quantity demanded increases. But we could ask, and it's relevant to ask, especially when we start talking here, why does this happen? And there are two reasons this happens. there is, where can I write this? I think I'm going to have to write here. There are two reasons quantity demanded goes up. And what can I do? Let's write this in blue. And let's kind of write it not in such a broad point. The two reasons are, one, the so-called income effect, and two, I need to write smaller, substitution effect. So what we're really saying here is that, if we put some numbers here, let's just say, I always like to use these even numbers, $10, and we're buying 5, so you're paying $50 to get these 5. But then, if the price falls, and let's just have a huge fall at $5, then, of course, you could buy these 5 at 25, right? It's because 10, I can't write up there, right? Times 5 equals 50. But 5 times 5 equals 25. So basically, you could buy the same amount you were buying before, but at half the price, half the money. In other words, you'd have $25 left over. With some of that $25, in other words, your real income has gone up. Your nominal income, the amount of money in your paycheck, may not have gone up, but now you can buy more with less money. So it's as if you got a raise in real income. So you might just go ahead and increase the quantity you purchase because your income is higher. And then the second reason that you might want to increase the amount you demand, and by the way, you don't have to spend all $25 down here. You could spend it in other things. But there could be other reasons the quantity demanded goes up, and that is uh, gasoline. I don't know, what would we be talking about? Maybe entertainment. Before you were just walking in your neighborhood and going to local parks. But now that gasoline's cheaper, you're going to go out to Big Bend. So you would have a substitution effect. You're going to substitute things in that result in even more being demanded. Usually you would think of this as a product, but that you're giving up and then buying more gasoline. But the idea is that if there is a substitute, you'd buy less of it because its price hasn't gone down and more of this. And so the total increase in quantity demanded is due to the income effect and substitution effect. So as we get into this and we start describing this aggregate demand curve, we want to probably use some similar arguments as for microeconomics. All right, let's head off to the next one. And I put the circular flow in here just to remind you that aggregate demand is this whole amount of money coming into this market. And I think I will increase the tip size here again, right there. And so you have consumption spending flowing from households into the market. Let's call this C. And I guess we can look at this. Let's see. Oh, it's still pretty big. Let's call investment. It's right here. Comes from business firms and goes up and joins with consumption. And so let's call this investment spending. The flow is like this. Of course, this flow is like this. let's use red for the government, and government has expenditures coming out like this. And so all of them are joining together for the aggregate demand here. Oh, we forgot the foreign economies. There is money coming in from the foreign economies. Oh, I need another color. Let's change this color to what? I don't know. Oh, how about green? And so money, foreigners buying goods, even raw materials like lumber or agricultural goods, are joining with these other three flows. These are all demanding things. But then, some of the things we buy aren't produced here, so they flow out to foreign economies. And that's true of governments too. Government buys things from foreign economies, and business firms buy capital equipment from foreign economies. So we're going to have some leakage here. Let's change this color again. I don't know what. How about purple? So there is going to be an outflow of money here down out of the economy. And these are for imports. And what did I use that one? Other one was green, right? So these are exports. So they're paying money for exports. And so what we have here then, if we go to black, all together coming into this market is the aggregate demand for all goods and services, which is equal to household consumption, gross business investment, government spending for goods and services, exports. That's all of the money flowing in. Then we have to talk about the money flowing out, imports. And these two together give us net exports, okay? And so there's aggregate demand. And then right here, this is a micro one. We're going to have to change that to a macro version of a market. And instead of price per unit, we're going to have a price level. And instead of just some quantity of a good, we're going to have real GDP here. And this is going to be aggregate demand. And we'll talk more about aggregate supply. This is going to be aggregate supply. And this is going to get a lot more complicated, but basically, that's the way we're heading. And of course, everything that's being done now is the Fed and the monetary policy is trying to ease things up here for businesses and hoping households will own more so they consume more and that businesses invest more. And it's easier for these firms that are under stress from the coronavirus to pay their debts. And the government is trying to inject, they're going to just be giving money right away to households. It looks, I forget how much, but what is it, $1,800? I forget. But unless you make, I forget the cut up, on more than 100,000. And there's all sorts of money being given to all sorts of people to try to, the idea is to increase aggregate demand so business firms can stay in business. All right. So there we have that. And now we have the aggregate demand curve, which we've already talked about. And it specifies a relationship between the price level, PL, which you see right here, and the quantity demanded of real GDP, which is right here. And you can see they use Q. We've already talked about that. That's fine. And now we're asking sort of what we had done up in a previous graph. Well, why does this thing slope downward and to the right? And so the rest of the lecture is taken up with the real balance effect, the interest rate effect, and the international trade effect. And basically, these two are very similar to the substitution effect. And this one is similar to the income effect for microeconomics, okay? So basically all of those three combine. So if a price level goes down, you might have the real balance effect. Okay, let's call this 1. Oh, I don't have much room left. 2 is here. This might be the interest rate effect. And then 3 is the international trade effect. And altogether, that would lead to this increase in the demand for real goods and services. And that's what this is about. It's just trying to convince us that the aggregate demand curve slopes downward and to the right. Later in the course, we'll take a look at a slightly different explanation for this, but for the time being, we're happy to do this. So the real balance effect just means there's a change in the purchasing power of dollar-denominated assets that result from change in the price level. So basically, dollar-denominated assets. So they're really talking about things like banking and checking, savings and checking accounts. Or maybe just that bundle of cash you have under your mattress. Yeah, just joking about that, but could be. There have been stories of older people dying and people finding huge amounts of cash in their house. They were saving for a disaster or a rainy day. And in fact, there's been a huge rush to cash right now, which caused the stock market to crash. Too bad about that. Anyway, the argument is just this, is if, in the first place, if the price level falls and you have $100,000 in your savings account, well, suddenly that $100,000 will now purchase more. In real terms, it has gone up. Just like in micro, your real income went up, even though your nominal income didn't. And even though your $100,000 didn't increase, it will now buy more. Monetary wealth rises, you buy more goods. And so you increase the amount you purchase. However, on the other side, if the price level rises, well, that $100,000 won't purchase as much anymore. Its purchasing power falls, your monetary wealth falls, you buy fewer goods, and essentially reduce the quantity demanded. So this whole thing about the purchasing power of your savings or checking accounts is called the real balance effect. All right, so there's our number 1. If we go back here, there's, our number 1 reason. Okay. We could ask how big is this effect? And I wouldn't say it's tremendously big. The amount of monetary wealth in checking and savings accounts is, well, it's about 6 times the level of GDP if we're using the broadest measure of money that we'll be looking at, M2. So GDP, let's just say, is 20 trillion. So it'd be 120 trillion. So if price level went down, well, yeah, if we put a big number that we can calculate, 10%, it would be like an increase in purchasing power I think I should have said 120 trillion, 12 trillion, which is much bigger than the stimulus bill. But if it just goes down by 1%, it's still pretty big. Well, maybe I'm wrong. It could be big. Okay, if the price level falls by that much, your purchasing power would increase. You'd be willing to demand more. So then the next one, this is a substitution effect. It's a real interest rate effect. This is like watching dominoes fall. There's just so many. One thing causes the next thing causes another thing, and the other thing causes another thing beyond it. So watch this. So price level falls. Well, your purchasing power rises with the given amount of money. So, by the way, they're not telling us. They're assuming nominal income remains the same. All right. So if price level falls, your real income goes up. You can buy more stuff, even though your nominal income didn't. You need less money to buy a fixed bundle of goods. This actually sounds like the real income, like the income effect before. But watch what happens. Well, because you don't need as much money to buy the same amount of goods, you save more. As you save more, the supply of credit rises. The amount of money people are saving goes up. Interest rate falls. Businesses and households borrow that money at that lower interest rate and buy more goods with it. And so what we're leaving out here is that not only do we have the final goods and services market, but we're really talking about the money market here. And we're talking about the interest rate being the price of borrowing money or saving money. And then, of course, loanable funds, the amount of loanable funds or money here. And you have a demand. This is microeconomics, and a supply. We'll call this supply 1. And let's say interest rate 1, and the amount of loanable funds are actually money. We can talk about money borrowed and lent is here. And then this is 1. And then because purchasing power rises, you save more. So the supply curve shifts out, taking us to interest rate 2. Interest rates fall. Because interest rates fall, businesses and households borrow more and spend it. That's what's happening here. And it reverses down here. If price level rises, your income isn't buying much. You have to borrow money in order to continue to buy the same amount of goods you were buying before because your nominal income has not changed. And so then you go out and borrow money to try to keep up. So interest rate rises. I guess here the demand for money increases, right? Pushing, I guess it is different. So here you would have supply and demand, interest rate. Let's put money here just to do this quickly. Demand 1, supply, and maybe you would save less as you try to maintain it, right? They didn't say that, but we'll put it in anyway. And because you're still trying to maintain your standards of living, you're going to demand more. You got to borrow money. And so essentially, it looks like the interest rate would go way up. It doesn't. All right. And it doesn't look like aggregate demand would go down. Well, yeah, it should. I suppose this would be it right here. All right. Anyway, the point is it's the opposite of what was happening here, I think they're trying to say. But anyway, watch this. So price level rises. 1, purchasing power falls. 2, borrow more money. 3, demand for credit rises. There you go. which is 4. Interest rate rises, which is 5. Businesses and households borrow less, which is 6. Buy fewer goods, 7. So, wow, there are a bunch of steps to get to here. All right, I was just thinking about that. Yeah, well, we'll get to a different way to derive this later in the course. And here's another substitution effect, and we have a bunch of things too here. Let's just count the steps. Price level falls relative to foreign price levels. And really, what they're sort of assuming here is that we have fixed exchange rates between currencies. With floating exchange rates, these change in purchasing power due to inflation or deflation are fixed within a relatively short time. So they must be saying fixed exchange rate is sort of the assumption here. So if it is fixed and the price level falls, so then U.S. goods are relatively less expensive than foreign goods. So Americans will stop buying foreign produced goods because the domestically produced ones are cheaper now. Compared to the foreign ones. And even if the foreign goods haven't gone up in price of their own currency, like yen or pounds or something, or euros, it takes more dollars to buy them. So from an American point of view, their price has gone up. Foreigners, however, have to spend fewer yen, pound, and euros to buy a dollar, and hence American goods prices go down. So what you find is that the demand for American produced goods goes up because of this international trade effect. Vice versa happens if the price level rises in the US relative to foreign prices. US goods are relatively more expensive now. Both Americans and foreigners buy fewer goods, and quantity demanded decreases because of this substitution effect, okay? And basically, I think we've reached the end of the road in trying to explain why the aggregate demand curve slopes downward and to the right. The real balance effect, the interest rate effect, and the international trade effect are arguments to try to convince us to believe that this aggregate demand curve slopes downward and to the right. All right? Well, see you at topic number 22.